what is possible when it comes to sales? Well, I'm going to show you some stuff today when it comes to mortgages, because what I've found, like I said, I've been doing this since 2019 pretty much full time. I've been in the industry for 13 years now. And what I've found, and probably many of you found this as well, is especially over the last few years, the ceiling of what is possible as a mortgage broker is way, way higher than what the industry actually tells you. Most people kind of talk about this, we're going to hit the 6-figure mark, we're going to make 100 grand as one-man advisor. And that was always, especially back in the day, that was that kind of thing. And everyone wants to do it. And £50 a month premium, insurance premiums is like a win. Like everyone's well happy that they've signed a client up at £50 a month and maybe 4 out of the 10 mortgages that they did. That seems to be always like the industry average. And about 3 years ago, I kind of got obsessed with this idea of like, is there probably more to that? They could probably do more than that. And so what we actually did was focus really heavily on sales psychology. And what actually happened, I'm going to share a few results with you. Now, these aren't big outlier results, so don't worry, there is others too. But recently, we had somebody who did 54 mortgages in 1 month, a consistent case average of £3,140. This is another one where we had this specific advisor did £170,000 in 1 month. This is what we call a 1.5 man band. So this is one advisor and a part-time admin did £170,000. Now, by the way, not everybody's doing this with working with me. So just to point that out, I'm very advocate on that. But it's showing you what the actual ceiling can be. The other thing we have here is this specific advisor that we've been working on. We've been working together for about 18 months now. But in the last year, again, this is another one a bit, £346,000 they're making on their own. All of this is coming from maximizing the sales opportunity. That's what it's all about. It's not about generating leads, because everybody thinks we need more leads. No amount of leads is going to get you these results. Now, like I said, how do we do it? Well, we do it with psychology. It's the only way. There's none of this kind of scripts and stuff. The problem with scripts is you don't need to just read the script. You need to know why you're doing it. It's all about the intention behind why people are actually doing the job. What we're going to talk about today is 6 psychology hacks mortgage brokers should use daily that drive trust, urgency, and more conversions. These are 6 sales psychology things that will, if you follow them, increase your revenue, but also can be used with marketing and everywhere else. It's not just about the sale itself, it's about everything at the front end of it. The first psychology principle we need to look at is known as the halo effect. Has anyone heard of this one before? Awesome. The halo effect is, if the first thing looks good, if part 1 looks good, the rest of it will look good too. This is the whole concept of the halo effect. So if something is good at the beginning, it must be by default everything else is good as well. So an example of that here is, first impressions matter, show up sharp, be seen as premium or relatable, and don't blur the line. So from a halo effect point of view, how do we use that in mortgages? This is where first impressions matter. So we talk about content. This is where content comes into sales. If you are good on your content and you look good and you look professional, so to speak, doesn't have to be like dressed or anything like that, but if the first thing is good, people will assume everything else is good too. It doesn't have to be good actually, they will just assume it's good. Now this happens in all different parts of your sales process and your customer journey. So you want to be looking at this, you can use the halo effect to massive opportunities with this, is when someone's on the call with you, let's say you're doing a Zoom call for your clients, the first thing they see will absolutely change the way they perceive everything. So if anyone's seen my studio, anyone seen my office, that is the halo effect. I spent a load of money on a tiny 2x2 room to make it kitted out with all the right stuff. And do you know all I did with that? All I actually did was Google Joe Rogan podcast equipment. That was like in the COVID, and I just bought everything that he had. I bought all of the microphones. I didn't know what any of it was, but what I did know was if I looked good on camera when someone got on a call with me or a client speaking to me and my audio sounds good and my visuals are good and my lighting's good, they would instantly assume I was good too. Next one we have is loss aversion. Anyone heard of this one before? No? So loss aversion is people fear losing more than they love gaining, okay? So frame protection specifically around this, around what they'd lose, not what they would gain. So loss aversion, massively powerful one that will have so the other one will get you more credibility. This one will increase sales and insurance sales specifically if you do it correctly. So what this is we are wired as humans to be more susceptible to fear losing something. We don't care about gaining something. And this is where people go very wrong with marketing, with branding, with everything, is if you think about if we go right back into caveman days, if we don't have something, we know we can exist without it. Our life is existing right now without it. But if we lose something, there's a part of our brain that goes, that could affect our survival. If we don't have that, we could actually, maybe not be successful. This can happen negatively as well. It's a really bad thing that happens to a lot of us. So for example, any of you might have this where you've had a really bad introducer, like an estate agent who's just an absolute prick, but you're like, but I can't get rid of them. It's like, oh, but if I lose them, I don't know what's going to happen. That's loss aversion in place. This is why you have things like gym memberships. And gym memberships give you a 30-day free trial. Once I've gone for 30 days, I'm much less likely to quit because now it's mine. And once it becomes mine, I'm making a decision to give it up, not a decision to buy it. And so how do we do this with insurance? Well, the problem people do with protection significantly is talk about what they're going to gain. So they're like, if you lose your job and stuff, you'll get income. And my favorite one is like gimmick selling. So it's like, oh, you get an Apple Watch. And what's actually going through the client's head, whether they are thinking it or not, consciously, subconsciously, their mind is going, well, I don't need an Apple Watch. I'm fine with that one. Or I don't need a free coffee, or I don't need a cinema ticket, or I don't need access to a GP. This is the problem when we sell benefits. What we should be doing instead with stuff like loss aversion is drawing attention to what they have. So what do you do with your kids? What do you do with your life? And you build this story up with them. Okay, what have you got? Draw attention to what they have and then remove it. And you don't even ask them what would happen. I actually use, with my clients, we've got like a structure we follow, and there's a thing called a financial resilience check. And we build it up. We show them how much money they make, and then we delete the income. And when we delete the income, it tumbles down. And we don't say anything. Most of my clients, we talked about insurance for less than 20 minutes across 2 1-hour calls. And yet we're getting 150, 200 pound premiums because we allow, this is a big one, to kick in. Is that when they see that number drop, their life, they go, I can't do this, I can't do this, I can't do. The moment you start telling them that they lose. It's a big, big thing with loss aversion. So you want to think about, build it up to take it away. That's how you do it in the conversation. So draw attention to how great their life is, how awesome things are, and then go, taking it away in like a conversation as if you didn't mean to do it. So you then provide a solution, but it doesn't look like you're trying to sell it. But that is loss aversion in a nutshell. Third one we have is social proof. So we trust what others trust. Most people see others working with you, and that means it's safer to follow. But this is a really, really, really important one, is that we are, again, all of this goes back to like kind of tribal mentality and tribal psychology, is that we are more likely to act in line with what other people do. And so because of that, with our sales, we should be drawing attention to what other people do. Now, when I was a broker, and if your hands up to see if any of you guys do this too, when you do insurances, I would always do this thing. I would sell insurance, I'd say, look, hardly anyone can actually afford the whole thing, and so I work with people to find the best possible solution for you within your budget. I would do that. I would do it all the time. What we did, a simple change to the process, was when we introduced insurance, we said, nearly always, everyone takes the full amount. Nearly always. And only a few individuals, if they can't afford it, that we work with them to try and reduce as much cover as possible. But it's always going to be my ultimate goal to eliminate all the risk. Now, that shift of normalizing that everybody else takes it, premiums went up. Purely because we want to act in line with everyone else. But if we are constantly defaulting down to, no, it's okay, I will do a budget. What's good for you? And we're going to talk about that in a minute, budgets and stuff. But that is a really important thing. Be careful what you're saying. Fees is another one. If someone queries a fee, people go, oh, what do I do? You say, do you know what? I've never had anybody query it before. As an instant shutdown. They go, why is the fee? Do you know what? I've been doing this 10 years. You're the first person to ever ask me that. Instantly feel like, oh, wait a minute. I don't want to be the outlier, because it goes back to the thing of the person who's out of the group will be eaten and killed by the lion. So you're playing into that ego and they want to fit into the group. So, anchoring effect. Anyone heard of this one? Price anchoring is what it's sometimes referred to as. The first price or idea changes how everything else or how others feel. Start high, then simplify. It makes your offers feel like a win. Price anchoring is the biggest thing when it comes to getting over budget. The price you anchor to, or the idea, whatever it may be, is the initial grounding point where people will judge everything against that. Now, Where is this a problem? We talk about protection again. Where is this a problem with protection? Well, if you are anchoring to pet insurance, which the amount of people like, oh, you insure your pet, but you don't insure yourself. Like, I insure my pet for like £25 a month. And now, great, I'm going to think about that. We are anchoring to the wrong stuff, completely the wrong stuff. Now, how we get these big premiums with me, what do we anchor to? We even hear when people do this, actually, with one where they go, what's your budget? Oh, £100 a month. Well, actually, when you ask a client a budget, they've anchored. They've dictated the anchor, not you. They've gone, oh, I'm happy to pay 100 quid. So when you come to them and go, well, to insure you, because you're on, both of you are on 150 grand a year each or whatever, some like big earners, and they're like, oh, I want like £100. You're like, that's going to cost you like 350, 400 quid. And then they're going to go, oh, well, I'm only happy with 100 because they've anchored. So you need to take control of the anchor. Do not allow your client to anchor, which is why budget is banned all the time. Worst case scenario is like anchoring to like the pet insurances and kind of general GI. It's better than nothing. An insured client is better than an uninsured client. But then the next anchor you see people do, not a fan of these ones either, but it's better again, is the 10% of the mortgage. This is okay and is taught by quite a lot of people. The problem with the 10% of the mortgage is that if you've got an earner, let's take, I don't mind, I'm quite open about this. I've got an offset mortgage with like 60 grand in it. So if you did 10% of my mortgage, you're not getting much. As a lifestyle, my wife doesn't work and I probably need about 7 grand a month. I actually personally have full cover. I take about £600 a month in insurance. If you just did a 10% of my mortgage and you anchored to that, I'd think that was adequate. This is the mistake people make as well, is they will listen to you and think you're the expert. So if you say 10% is enough, I will assume that is until it's not. So what we do, and this is where you go to your thing there, is we anchor to 5% of the net income. 5% of the net income, if you make that shift and make that clear to your client, that instantly is going to again increase premiums significantly. Especially when we do stuff with financial resilience checks, which is like anchoring to what everything else is. So the anchor is your mortgage is going to be 30 to 40% of your income. Your lifestyle is going to be 30 to 40% of your income. But for 5%, you can stop all of that from ever being a problem. Next one we have is scarcity effect. People value what feels rare, limited access, high demand. No one chases what is always available. How does that work with you guys? Quite easily. Scarcity effect goes back to what you said before about time. Being very clear with the client of, look, I've got this hour with you, and this works really well if you've built up your brand online and built up this perception of being very busy. You're like, we have this hour, it's got to get done in this hour. If it's not done in this hour, I'm off. I'm not going to be the person picking up your calls at midnight because you feel scared. We got this hour, we got these hours, and you speak to my admin. So the scarcity effect is really useful when it comes to increasing sales and conversions. So one of the ways we use this with the scarcity effect with how I work with clients is when you do a discovery call, and you finish the discovery call, you're waiting for documents to be submitted in. And we say, look, I won't look at any of your documents. I won't do anything for you until you've submitted them all in. I look at new documents every Monday and Thursday. So if, say like today's Tuesday, I'd say, if you get me to me by Thursday, I'll look at them. But if let's say it was Wednesday night, if you get them to me tonight, I can look at them. But if you don't get them to me before that, after that, I'm not going to look at it. Now on that list, what we also have on there is everything. We will not look at something unless everything is on there, including full medical. So I want everything from you before, if you want to do that. I need your full, it's like a 4-page, it's actually longer than that. It's all on like GHL, you can do it that, but it's like a long medical, everything I need to know, your inside leg measurements really, to be able to get full quotes, real quotes. And so that is a scarcity thing of like, I don't have time to deal with it. So if you want it, you got to get it to me now. And that again will increase sales because it will actually compress the amount of time you're with a client. Many of us think that by being really available all the time to our clients and being there to deal with their whims and their side, they're like, oh, I need your help with that. It instantly actually is devaluing your time and devaluing the perception of how good you are, which then kind of this one, if not done correctly, erodes the other 4. Because the other 4, they start seeing you as, oh, he'll do as he's told or do as she's told. And the last one we have is mere exposure effect. So the more they see you, the more they like you. Visibility builds trust before the first message. Truthfully, you want to be talking about this stuff on your marketing first. You will increase sales and conversions, as in sales revenue, by just putting it into your content and being everywhere. If that message is consistent everywhere, they won't question it. But the mere exposure effect is vital, and actually goes back to what we were talking about before. That is the one that if you've got nothing right now, you're a new advisor, you don't know what to do, The only thing you have going for you is just be visible everywhere, all the time, talking about the same thing over and over and over again. People will like you. People always, and I'm sure most of you have had this. I had it with me. People, when they first see you, think you're an idiot. They're like, oh God, they see me going again and again, and you annoy them. But I've got people I work with who have followed me for 5 years before they started working with me. And he said to me, I thought you were a bit of a prick, really. I thought you were a bit of a know-it-all. You think you do this? And he was like, but after 5 years, I started to realize, like, you do know what you're talking about. You're not in mortgages for short term, you're in mortgages for long term. And so if you want the ideal client, you want that client who takes full insurance, you want that client who doesn't quibble your fee, you want that client who takes all your referrals and all your kind of extra stuff on and the bolt-ons, then you need to create content that talks about that. And then just embed it into everything.